So overall, I think we're not at like bear market depths of like depression, but we don't have characteristics of multi-year tops. And I look at other things. I look at like the age of coins moving on the network. I look at Bitcoin in relation to what's going on in macro. I look at the MNAV, so the market value to net asset value of publicly traded Bitcoin treasury companies. Nothing right now is indicating extremely high froth levels. I think we're more in like a mid-market type territory.
The cryptocurrency market today finds itself in a state of uncertainty, neither caught in the frenzy of speculative euphoria nor languishing at the painful lows of past bear markets. With volatility subdued and capital inflows cooling off, many investors are beginning to wonder, has this cycle already peaked? To answer that, it's essential to look beyond short-term price swings and instead examine the deeper structural forces at play. Lyn Alden, a respected macro strategist and founder of Lyn Alden Investment Strategy, offers a long-term perspective on where we stand. In a recent interview, she highlighted a critical factor. The United States has now surpassed $100 trillion in combined public and private debt. This unprecedented level of leverage leaves policymakers with few options other than continued monetary expansion. Historically, U.S. debt has only meaningfully decreased during major crises, such as the Great Depression and the 2008 crash, both followed by aggressive money printing. Alden argues we've entered a new phase of the sovereign debt cycle, marked not by collapse but by slow, persistent value erosion through inflation and currency debasement. At the same time, Alden sees America's global financial dominance gradually weakening. While no single nation is ready to replace the U.S. as a superpower, she believes the world is shifting toward a multipolar system, one where neutral reserve assets like gold and, increasingly, Bitcoin play a larger role. This doesn't signal an imminent crisis, but a strategic realignment. According to Alden, Bitcoin is currently in a mid-cycle phase, far from speculative highs, but firmly supported by macro fundamentals. And in a world of silent monetary dilution, being structurally aligned with assets like Bitcoin could prove to be one of the most powerful positions for long-term wealth preservation.
Yeah, so one thing I covered in that presentation is that we've crossed over 100 trillion debt, which includes public and private debt. So that's kind of total debt in the American system. It's obviously higher than that when you look at globally. One of the things I pointed out too is that the number of years that they've ever gone down is extremely low. So in the entire kind of period that we've been alive, and even our parents have probably been alive, the total debt in the U.S. only fell one time, and that was 2008 during the global financial crisis, and it only fell by 1% before they started money printing. And if you look at the longer data set, going back all the way to the creation of the Federal Reserve over 110 years ago, there were 4 other years where total debt went down, and they were all in the Great Depression. So 1930 to 1934, and then that got too painful for them, so they printed. And so 5 years out of the over a century where they ever let that debt fall, because the way it's currently structured, central banking with fractional reserve banking built on top of it, and then debt securities built on top of that, it kind of has to keep increasing or it runs into issues because it's so incredibly levered. When it gets levered 20 to 1 or 50 to 1, as it normally is, 50 to 1 being at those kind of peak periods, they don't really have any ability to ever let that even unwind a tiny bit, because even a small unwind is like bigger than the monetary base. And so they're pretty quick to pull the money printing trigger. As for how bad it's going to get, so we're already past kind of the private sector deleveraging peak. So the 2 times in American history where that happened were, one, the Great Depression, so early 1930s, and two, the Great Recession, the global financial crisis of 2008, 2009, and the few years after that. And now we're more in the public debt cycle, which is that more debt is transferred to the federal level. Basically, I view it as more of a long grind than an event.
This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to Portfolio, tap your Solana asset, then click Close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
So, for example, I'm not really calling for a crisis in the next handful of years. I mean, who knows what can happen with war or geopolitics? But aside, not putting that stuff aside, in terms of just the U.S. money system, I'm not really looking for crisis. It's more like positions that are currently disadvantaged are going to continue to be, and ones that are currently advantaged are going to continue to be. And so, basically, if you're on the right side of those deficits, it generally feels pretty good, and people wonder why are people complaining? What's the issue? And if you're not on the right side of those deficits, you're getting squeezed pretty hard because you're getting all the debasement associated with those deficits, but you're not on the receiving side. So you're getting diluted. There's kind of this value being transferred away from those people and toward others in a fairly opaque way. So how bad it's going to get depends on how either fortunate or unfortunate you are in the stack, and then also what you're doing, be aware of it, and then protect yourself from it.
And what do you think could happen or will happen if the US as a nation is going to lose their reserve status?
Well, I think that's more of a process than an event. If we kind of point to when did the UK lose their reserve currency status, there's a couple milestones that were important, but none of them were like the day. And so there was a period of time where the U.S. surpassed, the biggest economy in the world. Then Bretton Woods moment was obviously a huge moment, but the UK debt was still pretty widely held. Then there was the Suez crisis, where the UK lost political clout, and then it's really been a long grind of losing it ever since. There's still a reserve currency, they're still in the top five of like held currencies, but not very much. And they've never had this kind of massive crisis because of it, but they've had a deterioration in their global standing and kind of the aftershocks of that. So I think that the U.S., by some metrics, we already hit peak U.S. dominance, which is you can look at, say, U.S. dollar share of global reserve assets. You can look at U.S. Share of global GDP. There's a couple of different metrics you can look at. Whether or not the U.S. is the biggest trading partner with most countries in the world or not, we've lost that to China. And so I do think we are over our hump. We're over our peak. But I think there's this kind of like long tail that goes forward. In addition, people, when they think that, often assume that another currency has to replace the former currency. But historically, that really only happened like one time. For most of history, kind of modern history as we know it, gold was really the global reserve currency, and the other currencies were just these like overlays on top of that. They were instruments that were generally backed by gold or backed by silver in some cases, and it was whatever the kind of the country that was exploring the most, that was kind of this biggest growing economy, and therefore the most recognizable. And as they would kind of expand and then contract, and some other entity would take over, that would kind of displace them. But ultimately, it was gold for gold and silver for most of that history. We did have a handover where the UK went to the US as a global reserve currency, but people often assume that the US has to hand it over to someone else, like China or whatever the case may be. I make the argument that this period was an anomaly. This isn't something that's going to keep repeating. This kind of U.S. dominance period was an anomaly. So after World War II, the U.S. was over 40% of GDP. Most of the world was destroyed. The U.S. had by far the most gold, biggest manufacturing base, really strong demographics, by far the biggest military. The homeland was mostly unscathed by the entire war. And so it was just like a hyperpower position. And so everything was kind of built on top of that. And over time, we've fallen from over 40% of GDP to 15 to 25%, depending on whether you're looking at nominal or purchasing power parity GDP. We're no longer the biggest trading partner. And so as you kind of go by different metrics, we've been shrinking. But there's really no other currency block that's going to recreate that 40% of GDP hyper dominant situation. And I mean, if anything, that's a healthy thing. That was an anomalous period where like most of the rest of the world was destroyed. And if you look at kind of long run history, like China and India used to be pretty big percentages of global GDP, stretching back a very long time. But in the era of kind of Western exploration and colonialism and stuff, I mean, they were on the wrong side of the technology war that happened. So they radically shrank as a percentage of global GDP despite their large populations. And if anything, the recent return of India and China to rather large chunks of global GDP is back to the normal state of affairs, given the size of their population and the long-standing history of their cultures. So I think we're entering a more multipolar world is kind of the punchline after that long ramble I just gave. We're entering a more multipolar world, which generally means two things. One, neutral reserve assets reassert themselves in the system. So the biggest one would be gold, but obviously Bitcoin's a newcomer with a lot of really attractive characteristics. And it also means, to the extent that fiat currencies are held as reserve assets, there could be more diffused holding of them. So rather than one being, say, 70% and like the next four making up the other 30%, you might have the top one be 40% or 50%, and the other four make up, the rest of that, or the other nine top ones make up the rest of that. So you have a more diffused currency base.
As we evaluate Bitcoin's trajectory, a major shift is emerging in how capital views the asset. While retail traders and institutional investors continue to influence price movements, a more strategic and long-term player is beginning to take notice: sovereign wealth funds. Unlike central banks, which prioritize liquidity and stability for short-term deployment, sovereign wealth funds invest with decades-long horizons focused on capital preservation and growth. For these allocators, Bitcoin's volatility, often seen as a weakness, matters less. What stands out instead is its asymmetric upside, growing liquidity, and improving regulatory clarity. These traits make Bitcoin increasingly viable as a small, strategic allocation within long-term portfolios. We're witnessing the early signs of a structural trend, where nations with strong currencies and multi-generational investment strategies begin integrating Bitcoin not as a speculative asset, but as a long-term hedge. This isn't a full embrace of Bitcoin as a reserve asset just yet, but it marks a critical transition from short-term speculation to strategic positioning. If this quiet shift accelerates, especially in an era of declining trust in traditional monetary systems, it could become one of the defining forces behind Bitcoin's next growth cycle.
Which statistically mostly means the time it went to or from an exchange. Those are the biggest moments for that metric, and that creates kind of a psychologically important number. It's kind of like volume adjusted market cap in a way, because, and the analogy I use, if you have 20 houses on a street and none of them have sold in a few years, and one of them sells for double the price that it last sold at, you'll generally see that all the other homeowners mark up their real estate at to the level that that new one sold at. But that's the liquid price. That's like, 5% of those houses moved and the whole street's now twice as valuable. But it's not clearly the case that if 10 of those were to sell, they would all sell at that higher price. And Bitcoin's obviously a much more liquid asset than that, but there's still a part of truth to that, which is if you get a really quick price move to a new level, if it does start to unlock a lot of existing supply, that price is not necessarily maintainable at that new high level in that window. But if it kind of reaches a price level and then spends 6 months or 12 months or 18 months chopping along at that level for a period of time, and the cost basis goes up and a lot of volume and a lot of liquidity has occurred at that new level, then that's a more meaningful liquid kind of price level for the asset. And so during prior multi-year peaks, we can call them bubbles, I suppose, because you kind of had a few years of a bear market afterward, they hit very high levels by that metric. Currently, we've not hit anywhere near the levels that are historically associated with multi-year drawdowns. There are times we hit, I would call it moderately frothy. So, for example, in March 2024, which was the near-term aftermath of the launch of the US spot Bitcoin ETFs. So there's a little bit of a fervor there, a little bit of a rapid price jump. We briefly touched new highs at something like 73,000. And that metric got a little bit frothy, but it was nothing like one of those, multi-year periods. And then we did end up consolidating for like 7 months, which makes sense given the moderate froth we had. Then, shortly to your point, right after October, when we had an election in the U.S., a much more favorable environment to Bitcoin. That was kind of a catalyst, but that was after a 7 month consolidation. We were in a pretty good space valuation wise. We jumped up to, what was it, 107,000 or 108,000 thereabouts, and that reached similar levels of like moderate froth. Again, from November until April, May, we were in this consolidation phase, which makes sense. A multi-month consolidation for a little bit of froth. We eventually worked past that. We've touched new highs. We pulled back a little bit. So overall, I think we're not at like bear market depths of like depression, but we don't have characteristics of multi-year tops. And I look at other things. I look at like the age of coins moving on the network. I look at Bitcoin in relation to what's going on in macro. I look at the MNAV, so the market value to net asset value of publicly traded Bitcoin treasury companies. Nothing right now is indicating extremely high froth levels. I think we're more in like a mid-market type territory.
Lyn Alden doesn't believe we're in a late-stage bubble. In fact, she sees us still in the middle of Bitcoin's bull market. A key metric she follows is the market cap to on-chain cost basis ratio, which compares Bitcoin's total market value to the combined cost basis of all coins on-chain. This ratio shows how much of the market holds unrealized gains and whether sentiment is overheated. Currently, the ratio is far from the extremes seen in previous cycle peaks like late 2017 or early 2021, indicating a more moderate market. Alden also notes that long-term holders are not selling into strength, a sign of a sustainable bull market, supported by indicators such as coin dormancy and coin age. She highlights strong macro and structural factors backing this phase, including rising adoption, improving liquidity, favorable fiscal conditions, and a steady inflow of institutional and sovereign capital. These elements, Alden argues, lay the groundwork for durable price appreciation rather than a short-lived speculative spike. The recent market volatility, she explains, reflects a healthy digestion of gains as the market prepares for another upward leg rather than signaling an imminent peak. In summary, Alden sees this not as the end of Bitcoin's bull run, but potentially the start of its most transformative chapter. The real blow-off top and warning signs typical of market peaks are likely still ahead. If you found her analysis insightful, join the conversation. Do you believe Bitcoin's best days are still to come, or do you think there are hidden risks the market is overlooking? Share your thoughts in the comments below. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.